Donald Trump is ushering in 3 economic resets, and we're going to talk about each of them. The order we're going to go through this is simple. We're going to talk about the Federal Reserve first and the economic reset that they are facing, which is important for you to know what the headwinds and tailwinds of Federal Reserve policy are going to be for your money. Then we're going to talk about Donald Trump's economic reset, and of course, we're going to talk about what's coming after everyone's jobs and the AI economic reset. The first topic that we have to touch on when it comes to the Federal Reserve has to do with the Beveridge curve. Now, you may not have heard of this curve before. That's because it's a pretty arcane and boring economic topic, but it'll help you understand and see exactly what the Federal Reserve is facing today. Here is a classic Beveridge curve. This is a curve that economists use to show the relationship between job openings on this end of the curve and the unemployment rate. And you can see there's a traditional pattern that this curve follows. Essentially, as job openings fall, the unemployment rate moves over to the right. This makes logical sense. Think about that for a moment. If you have fewer job openings, fewer people are getting jobs, and so the unemployment rate is going to move over to the right. So in other words, you historically have a curve that looks downward sloping and to the right. Now, there are abnormalities that can happen during economic transitions, and that might be what we're experiencing today, because today we don't actually have a normal curve. And this is something that is giving the Federal Reserve heart palpitations, because our job openings rate has plummeted, yet our unemployment rate has remained low, which is very odd because it is not what you historically see in labor markets. And so this is where, if we put a picture up of what today's labor market looks like on the Beveridge curve, we'll end up finding a curve that looks quite demented. When we look at this, we can see, wait a minute, maybe this is why the Federal Reserve is a little bit nervous. Because as you can see, this isn't much of a downward sloping curve at all. If anything, it kind of looks like we're basically just a vertical curve over here. In other words, job openings are plummeting while the unemployment rate is staying low. So it's still on this left side over here. We're converging into this corner. This is not usual. And this is exactly why the Federal Reserve is extremely nervous and why you should be evaluating, okay, what does this mean for Fed policy going forward in the future? Well, what it tells us is very simple. It tells us that there is either a large problem in the economy or a transition. And both of these problems, or the transition and the problem, point to the same result. Let's analyze these. First, if we have a problem in our economy, such as delayed laying off because companies and businesses decide, we had such a hard time getting workers after COVID, we're going to just retain workers for a little longer. That could be an explanation for the low hiring or low job openings level, but also the low firing level. So low hiring, low firing. That could be an explanation. So in other words, we could be seeing a delayed normalization of the Beveridge curve, which is problematic because it means we're likely to see the unemployment rate spike. So in a delayed scenario, we're going to expect that unemployment insurance claims are going to skyrocket. The other potential is less damaging to the economy, but it could have the same outcome. And it is that the economy is going through some form of a transition. That is, current and existing workers are becoming more productive, potentially because of a change in technology like artificial intelligence. And as a result, the unemployment rate is low, but companies just don't need to hire to become more productive. Their current workers become more productive. And therefore, you could have low unemployment because you're not firing people, but you're also not hiring more, yet you're still able to grow, and the economy is still able to expand. This would be the technological change. The downside of the technological change in the near term is it is probably eventually also going to lead the unemployment rate to go up. Now, in the long term, technology tends to create new opportunities and new jobs, but it's during those periods of transition that you tend to see unemployment spike. Now, no matter what the cause is, the result is the same. unemployment is very likely to rise over the next few years, either through delayed firing, that is, companies say, hey, our earnings aren't growing anymore, our earnings are growing flat, in other words, they're not growing, let's cut some expenses and then we can grow our earnings per share and hopefully our stock can go up. That would be an example of delayed laying off. Of course, that could also create a flywheel where companies lay off because earnings are down, but then there are fewer people with jobs, so earnings go down even more, and then you get more layoffs. And that's usually how you get an economic down cycle or a recession, some form of a reset. And then, of course, with technology, you could see unemployment slowly move up, but productivity and GDP continue to grow, and you essentially have higher unemployment without a recession. So think of this as your recessionary unemployment, and think about this as your not recessionary increase in unemployment. And you could have a mix of both of these. The point is, unemployment is likely going up over the next few years until, of course, we come and discover new purposes for people to have work, and we see unemployment go back down, which could take decades. Think about people getting re-educated in trades or different skill sets or new opportunities in the future. It's going to take a while. So in the near term, unemployment is likely to move up. And the Federal Reserve realizes this. Both of these aspects will likely lead interest rates to go in one direction, and that's down. However, there is something that is keeping the Federal Reserve awake at night. There's something that tells the Federal Reserve we need to delay because we're not sure yet if we should start striking on lowering rates. Now, the answer is yes, they should start striking on lowering rates, but what is the Federal Reserve waiting for? Well, they're waiting for guidance on what's going on with price-related policy because of their dual mandate. They have two jobs. One job is to make sure that we have stable prices, and the other is that we have maximum employment. Well, we have maximum employment right now, but we don't have stable prices, and we're not convinced that even if we do have stable prices today, that those prices are going to remain stable. Now, why? Why would the Federal Reserve tell us, hey, we're not convinced that prices are going to remain stable? Well, it's actually quite simple because the Federal Reserve provided this guidance in their beige book released just yesterday. And so their beige book, quite frankly, gave us a time frame for what to expect. As you can see here, prices have increased at a moderate pace since their previous beige book. However, the contacts, and this is the national summary, so looking at all of the districts combined, their national summary suggests the following. Contacts, Federal Reserve has over 2,000 economists regularly talking to businesses and hiring companies, essentially. Contacts that plan to pass along tariff-related costs expect to do so within the next 3 months. So in other words, there's your time frame. The Federal Reserve is bluntly telling you, hey, we are going to have more guidance on where we sit with prices in about 3 months. Now, this is interesting because the Fed is now going to be in a place where they say, we're going to wait. Mind you, the economy and the job market weakening and transitioning is telling us cut. And this is where you have a disconnect between the two. The worst case scenario is that we start seeing rapid increases in the unemployment rate before we get that 3-month or tariff-related price drama behind us. So in other words, if let's say we're in July and we see a massive spike in unemployment, or we're in August with a massive spike in unemployment, the Federal Reserve might not yet be able to cut. We know in the future they're going to be able to cut, and they're going to likely cut by a lot because inflation, which we'll talk about in the tariff section, is less likely to be problematic in the longer term, which we'll explain why in just a moment, and they'll be solely focused on jobs. In the meantime, you're going to hear a lot of noise about weekly unemployment claims or what's going on with job reports. It's very difficult for us to care at all about any of these numbers until we have a longer term trend. This makes looking at weekly claims a fool's errand. In other words, it's almost worthless to look at it. Here, by the way, is a chart of seasonally unadjusted unemployment claims. And it shows you that typically in the summer and in, somewhere around the end of December, January, here's January, right? You tend to get a spike in unemployment claims. these claims really get leveled out through seasonal adjusting so that we don't have all this crazy up and down. But something you're going to notice a lot of people pay attention to over the next few months is people are going to say, all right, well, let's find 2025, which is right about here. There we go. And let's see what happens over the next few weeks in these unseasonally adjusted numbers. As long as they come down again by about week 31 to 37, which would be about the end of August, which is really interesting because the Fed gave a time frame of 3 months from May, which is the end of August, and their next Fed meeting that really matters is September. Well, then we'll know, has this started declining just like it usually does every single year? So the Federal Reserve should be in a pretty good place to see what's going on with labor market dynamics by September. The question is, will markets panic about this normal increase in unemployment claims in the near term? Well, in the longer term, it doesn't really matter because the Fed is likely to lower rates no matter what happens. But in the near term, you're setting up for this unemployment claim concern at the same time as you're up against Q2 earnings. And that is exactly why some folks are interested in diversifying to gold. Now, we do have to talk about tariffs, but we have a quick message from our sponsor who sells gold.
Not just any gold company, a gold company that's an education first company, which is awesome because you know me, I'm all about perspective and education first, and I call myself the no pressure agent. And that's what Lear is, a no pressure company for buying gold. It's the only company with a 24-hour risk-free purchase guarantee, over 27 years in the business, and over $3 billion in trusted transactions with thousands of 5-star reviews. Now, look, we've already talked market almost daily here. We know every institution seems to be hyping up gold, and it makes sense. Because if we're going to head into a recession, it's not so much the volatility of the recession when it comes to gold prices you want to worry about. Certainly a safe haven asset, but you know what I think. When that money printer turns on again, you know what people like investing in, and that's why people like diversifying away from paper money and getting into a safe haven asset like gold. So if you're interested in diversifying to gold, check out Lear Capital. Give them a ring or go to their website. You can call 1-800-707-4575 or go to Lear, that's Lear, Kevin.com for your free gold and silver reports as well as investor kit to learn how easy it is to own gold or silver in your IRA or just have it delivered to your door and you can do whatever you want with it. Under the mattress, in a safe, or you decide. Anyway, give Lear Capital a shot over at 1-800-707-4575 or learkevin.com. Also, keep this in mind. First-time buyers can get up to a $15,000 bonus in bonus gold with a qualifying purchase. So make sure when you call 1-800-707-4575 or you go to Lear Capital's website, learkevin.com, you ask them about that $15,000 bonus. Make sure to let them know Meet Kevin sent you.
But Kevin, what about the labor report? It comes out the first Friday of every month, including, oh wow, how convenient, June 6th. Well, the labor numbers absolutely matter because the Federal Reserve will panic when it comes to losing labor or losing jobs, losing this side of their mandate. In fact, if you look over here to June of 2024, right over here, you're going to find that this is about where the Federal Reserve cut rates by essentially 100 basis points, but 50 on one given meeting and then 25, because the labor market was essentially going straight to the poopers. Look at that trend line, pretty straightforward, right? But there's something unique that usually doesn't happen. Austin Goolsbee from the Federal Reserve told us the labor market usually does not just level out once it started to decline. But, and this is where you can credit, whether it's enthusiasm for Trump or Trump himself, well, it's probably enthusiasm given that it started to pick up in November and December. To some extent, you can credit Donald Trump, and this is just apolitically observing that jobs started picking up again in November and we got in December and into January, and you kind of got, whether it's this increase here and then a leveling out, we could call it, you kind of got an environment where we got a nice little boost from the Trump administration, either enthusiasm for how great business is going to be in the future, or his big beautiful bill or tax cuts or whatever. We did get a bump. Historically, we do not level out. This is very unusual. In a normal cycle, we fall into an unemployment-driven recession, and then we slowly recover out of that. Now, there are guesses in terms of how bad that kind of recession could be, but so far, these numbers are going to keep vacillating up and down on a monthly basis. They'll continue to get revised. Don't worry so much about the monthly numbers. Worry about the longer-term trend. This longer-term trend could be a normalization. And if we can level out like this, above about, ideally, 100,000 jobs per month, this economy can keep booming. And there's good news. At the moment, even bearish analysts forecast just a, quote, shallow recession starting in the third quarter with a Fed cut in September. This is Rabobank providing you their bearish outlook. Their bearish outlook is a shallow recession. They also say that the depth and length of a recession depends, of course, on what tariff scenarios materialize. And this is, of course, where we get into talk around pricing and inflation. And there are two really important components to pricing and inflation, two important components above and beyond just speculating about whether companies will have pricing power. We already know that I believe most companies right now don't have the best pricing power unless they're selling to rich corporations, like Nvidia selling to rich corporations or Palantir selling to rich corporations. They have pricing power because they're selling to customers with endless access to capital. However, companies selling to consumers are facing a harder time attracting customers. In fact, if you look at consumer companies like a Costco or even a Dollar General, what you're finding in their earnings calls is they're telling you, hey, one of the reasons we keep attracting customers is because we are so mission-oriented in driving prices down that we're getting more visitors, and in other words, greater numbers of transactions. But if you look closely at what both of these companies tell you, they tell you very clearly, we are reducing prices, and that's how we keep getting customers here. So when it comes to consumption-based companies, we're not looking at a lot of pricing power for consumers. Again, rich corporations, no problem, different story. There's plenty of capital that Microsoft and Apple and Amazon and Meta and Google have to spend, as well as large healthcare companies that can spend money on software such as that with Palantir or otherwise. And those can lead to booms in those industries, which is great. They have pricing power. However, consumer companies do not in this environment. Now, what matters when it comes to inflation and the Federal Reserve's mandate? Well, the Federal Reserve cares about something called the personal consumption expenditures rate, which is really this manipulated version of parts of consumer price inflation and some parts of the producer price inflation reads. Really, they're trying to find a basket that a normal everyday American spends money on. And what you'll notice is normal everyday Americans spend money on things like Costco and Dollar General goods, not on Nvidia and Blackwell chips. So in other words, where companies have the power to raise prices, consumers aren't buying and it doesn't show up in consumer prices. Where consumers are buying, prices are going down. So in other words, we should continue to see a or at least disinflationary trend in prices. Now, of course, are prices higher than where they were in 2019? Of course. This is because we had an incredibly reckless amount of money printing through both sides of the political aisle, and we have to deal with those higher prices now. Of course, that's my take on pricing, but what market signals can we see in regards to inflation expectations? Well, one, you could look at long-term inflation expectations, like the 5-year break-even or the 5-year forward break-even. These are great charts and tools that show you that inflation expectations in the longer term really haven't taken off. They're relatively stable to where they've been over the last year and a half. So in other words, markets in the long term aren't really pricing in higher inflation. And when we look at oil prices, some would argue that we're actually pricing in recessionary dynamics when it comes to energy pricing. Now, some of this could be because of additional supply from the Middle East, but a lot of folks usually see this 60 handle on oil, WTI. This is the Western blend. You could also look at Brent, which is the international blend, and find that some of these levels are starting to approach recessionary levels, which is good from a consumer price point of view, because usually in a recession, prices decline. You usually see deflation in a recession until, of course, the Federal Reserve turns the money printer on and absorbs all of that deflation and just raises prices again. But again, that's for the other end of this cycle that we're in. Here's another thing that you could look at. COVID-style supply chains breaking, and if you look at what Bank of America tells us, they say that our weekly bottleneck scale remained at 2 this week. In other words, there's very little congestion in supply chains. Supply chains are very open. They're not heavily bottlenecked. And so we don't think we're going to see a lot of supply-based inflation. Mind you, this is for the week of June 2nd, where we are already in the midst of this tariff warfare. So despite the tariff warfare, supply chain congestion is very low. A lot of this is probably driven by corporations who really cleaned up their supply chains post-COVID to make sure they could deal with shocks in the future, to always provide their product to customers and clients, whether that's front-running with more inventory or it's diversifying supply chains, whatever. The economy appears to be more resilient today. Now, based on all of this data, were it not for Donald Trump's tariffs, we would probably have secured a soft landing by now, because the Federal Reserve would already be in the mindset of cutting rates even more than they have thus far. In other words, tariffs have done a good job of punting rate cuts, and it does create a risk that the Federal Reserve will be too late. And so this is where we have to evaluate, where do we sit on tariffs right now? See, tariffs, and ultimately what you think about them, whether they're good or bad, if other countries use them, why don't we? Tariffs are economically bad. It doesn't really matter what side of the spectrum you're on. We can all agree that if the Federal Reserve was willing to cut in March, that has probably now been punted out to September or November. And unfortunately, because there is a lag in when the Federal Reserve cuts rates, if the Fed cuts rates in September or November because of an unemployment spike or a spike in layoffs, which is exactly what the Fed is worried about, then it will take even longer for those rates to take effect. Had it not been for tariffs, we could have started cutting even earlier and preempted that slowdown or normalization of the beverage curve, which is a slowdown in the labor market. Again, whether it's because of technology or it's because of lower pricing power at companies, that doesn't matter. Either way, the trend is up on employment, down in rates. The issue is we've now delayed rate cuts, heavily because of, actually probably almost exclusively because of tariffs. Because had it not been for tariffs, inflation would have been relatively stable. It is relatively stable, around 2.5 now. The problem is forecasts for inflation are now going up or are being predicated on what happens over the next 3 months. And this is why a lot of economists are worried about tariff negotiations and where we go in terms of how long these tariff negotiations take. Now, we did hear today that Donald Trump spoke with Xi Jinping. The problem that we find is markets react positively to any optimism around trade. However, so far on our progress of 90 deals or over 100 deals in 90 days, I think the marketing was 90 deals in 90 days, we've had no trade deals with a trade deficit nation. We've only made one trade deal with the United Kingdom, with whom we have a trade surplus, or at best case, we have neutral trade. This is somewhat problematic, because now the trade negotiations that our country is engaging in with other countries is now hampered by both court decisions, which show other countries that our courts are arguing that tariffs might be illegal, which essentially lead other countries to say, as we've already seen them do, hey, why don't we just wait to see what the courts say before we negotiate? That's not great. the impact of court decisions, like the court or not. You could agree with the court, you could disagree with the court. It doesn't matter. The impact is delay on the end of tariffs, which the more delay we get here, the more delay we potentially get at the Fed, which increases the chance of a Fed policy mistake. Again, the Fed being too late. The other issue on top of courts that you face is you also face political pressure, not only through the big beautiful bill and the pain that Donald Trump is now going through with Elon Musk essentially turning on congressional spending, which is extremely popular, by the way. A lot of people are very upset about the idea that we're going to add to our deficit rather than cut like what was advertised to most Americans. Both of these things lead to, in my opinion, delayed trade negotiations, which again lead to the Federal Reserve delaying their cuts. Now, hopefully, we can end everything by the end of Liberation, the 90-day Liberation Day pause, which would be great. We'd be over all of this in July, but because of courts and because of politics, we actually might see this tariff negotiation go on for the rest of the year. That wouldn't be great, because the longer the tariff negotiation goes on, the longer the Federal Reserve is going to punt rate cuts, and the more damage the labor market could end up causing. Now, this is where we have to evaluate, do we actually care as investors what's going on with the labor market? Unfortunately, the answer to this is yes, because generally, when the labor market induces a recession, just like the scare that we had in August of last year, the stock market could suffer rapid sell-offs. This is not abnormal. However, it could be a buy the dip opportunity, and which it is, we're going to talk about in just a moment because of what I think the Federal Reserve is going to do. But first, a message from where you might be able to do a great job buying the dip. Public.com.
And now for a message from our sponsor, Public.com. Folks, Public is a place where serious investors can build wealth. And I'll tell you, if you're like me, you might not realize how much the Public.com app has expanded. I mean, we're not talking just stocks anymore. We're talking stocks, we're talking bonds, we're talking options, crypto, exchange traded funds. And let me tell you, nobody knows about ETFs, but okay, we won't go that direction, but it's all in one app, especially since now they also have their high yield cash accounts or access to different funds that give you high yields as well, which, you know me, I'm personally of the mindset that, it could be a good idea to have a little bit of a rainy day fund sitting on the sidelines earning some cash before J-Pow takes those good yields away. So Public.com makes this easy. On top of that, they're integrating AI tools and fundamental data and analytic tools right into the app. They call it alpha, which is awesome. I like that phrase a lot too. In fact, everyone's looking for some more alpha after all. Now, what's neat about Public is you can fund an account in less than 5 minutes, maybe even less. And if you transfer your old portfolio over to Public, you can earn up to $10,000 as a bonus. Now, that's the kind of free money that I love, especially if I'm getting more bang for my buck. So if you're at a different brokerage and you're looking for a change, in my opinion, give Public.com a try. You can download the app, you can use my link in the description and down below and check them out. Public.com, use my link in the description.
Mike Wilson, who used to be the resident bear at Morgan Stanley, is actually telling you that a recession may be the perfect buy the dip opportunity. In fact, he says, quote, "We think recession probability has fallen significantly post the reduction in headline rates on Chinese tariffs from 145 to 30. Having said that, in the event we get a recession, not our base case, in other words, they don't think this will happen, but if we do, we think it would be mild and could actually present a bull case for stocks over the next 12-month time horizon." And to this, I actually agree that if we have a shallow recession, you could rapidly have another opportunity to buy the dip, just like what we saw in April. The true downside is the most bearish things we are finding from Wall Street analysts today is shallow recession. And this is where, when we look at history, we have to evaluate what did people say about the economy in 2001 and in 2007. Oh, folks, don't worry. Things are just normalizing. things are just leveling off. We're going to have a level off. Unfortunately, in both of the prior two recessions, where we did not have the Federal Reserve supporting us until the end of the recession, actually marking the end of the recession, the stock market suffered severe declines. In fact, had you bought at the beginning of 2001, it could have taken you over 13 years to break even on your investment. And certainly after 2007 equity pricing, it would have taken you 4 to 5 years to break even on some of your purchases. Now, for somebody who's dollar cost averaging, maybe this isn't a big deal. In fact, arguably, it's not. And when we talk about artificial intelligence and what you should do about this and how to adjust your own positioning, stay tuned for the end of the video because we're going to go through exactly this. Just remember, though, the bottom of these supposedly shallow recessions was very simply marked by the Federal Reserve coming in to bail out both of these situations, once in March of 2003 and again in February of 2009. That was your end. That was ultimately where we V-shaped recovery up. At the moment, the Federal Reserve isn't in this position, again, because the very thing that's potentially creating recessionary risk is also what's preventing the Federal Reserve from being able to bail us out. In other words, we can only hope that the tariff issues, whatever happens, whether we get deals or we don't get deals, we can only hope that we have the answers before the unemployment rate skyrockets. Because then the Federal Reserve is stuck between a rock and a hard place. And the question that a lot of people then ask is, but Kevin, won't the Federal Reserve just cut rates anyway as soon as jobs fall off a cliff? Why would they care about inflation if the jobs market is collapsing? They'll prefer jobs, right? I mean, they don't want people to be unemployed. Well, this is where I have really unfortunate news. Historical evidence tells us exactly the opposite is true. The Federal Reserve will almost always prefer price stability over the labor market. And we can evidence this by looking at what happened in the 1970s. In the 1970s, the Federal Reserve was what we could call hyper-responsive to changes in data that could affect the labor market. So hyper-responsive. In other words, if you look at rate changes in the 70s, Federal Reserve changed interest rates a lot. This really damaged their credibility. And that's not to say the Fed has infinite credibility today. They certainly don't. But the Federal Reserve was responding to an environment where we left the gold standard. We removed price caps, which led to immediate inflation at the same time as leaving the gold standard, at the same time as having an oil price shock. The 1970s were a little bit disastrous for fiat. How did we solve that? Well, we solved it. Mind you, also, Jerome Powell has criticized this era as never wanting to return to this 1970s style stagflation again. What does Jerome Powell promote? Well, it's exactly what we did to solve the issue of the 70s, and this is what we call the Paul Volcker era, where we actually had a very rare double-dip recession, entirely induced by the Federal Reserve tightening monetary policy to break the back of inflation. By breaking the back of inflation, they also broke the labor market, but it didn't matter. Losing jobs was a cost the Fed was willing to pay in order to regain credibility. And so, the rationale behind this is if you can't sustain prices, your entire country collapses. If you have joblessness, you might have a recession, but you'll live for at least another cycle. So, the Federal Reserve will almost always prefer stable prices. And this is why the tariff negotiations ending in a positive way before the unemployment rate skyrockets is critical. Now, markets today aren't really discounting that this tariff negotiation could go on forever. It seems today that markets broadly, with the exception of the oil markets, are saying, hey, you know what? The worst levels of tariffs happened in April. Everything's fine right now, and we'll get through this. True. But one of the reasons a lot of pricing changes haven't shown up yet is because a lot of companies built up inventory in Q1 to get through a few months of tariffs. That means the biggest risk for us is an extended trade war, and the courts just made this even more risky. Before we talk about artificial intelligence, let's talk about three charts that are false signals. The first is the money supply. This is a chart of the percent change of money supply. And a lot of people say, hey, markets can only keep going up because we must be printing money again because our money supply is increasing. How much money is available and circulating? This is the M2 money supply. But this argument falls apart when you actually look at it throughout history, because what you'll find is every single time you had a recession, the money supply skyrocketed. And you'll find frequently, not always, like right here is not an always, but you'll find frequently that money supply skyrocketing can actually occur towards the end of a recession. And we're in an environment, here's another one, we're in an environment now where we're seeing, an increase in the relative level of money supply compared to prior years. But could it potentially be the beginning of any of these recessionary points? Of course. It's too soon to tell. So just using or relying on the money supply chart, I don't think is very useful because it is characteristic of recessions and not to see an increase in the money supply. I would argue that this money supply chart will increase substantially should we go into a recession. But there are a lot of factors that could impact why money supply is increasing. Honestly, probably artificial intelligence has something to do with it right now, which is again contributed to our labor market woes, why we need those rates to come down sooner rather than later. But the Fed won't, because why would they? Take a look at the Atlanta Fed real GDP estimates right now. They are over 4% right now, which is remarkable, 4.6% on a GDP estimate for Q2. Why? How does that make any sense? Well, it actually makes a lot of sense if you understand the definition of GDP. See, when we look at the definition of GDP, GDP is really the sum of gross domestic product, all the things that go into it, consumption, trade, capital investments, whatever, minus net imports. So in other words, when we import a bunch of stuff like we did in Q1, our GDP level plummets. Okay, well, we did our importing in Q1. We front ran Q2. So now we're subtracting way less than usual. And so, of course, the GDP looks artificially high. Q1, artificially low. Q2, artificially high. So this chart that circulates frequently on social media isn't particularly useful either. And it won't be really until we get to Q3, Q4. Q3 is probably decision time for the economy, because in the third quarter is when we'll get not only Q2 earnings, but we'll get all of the data from the trade war to see, did our labor market survive? And we'll have guidance for what companies are doing going forward. Usually layoffs come slowly and then all at once. We don't want a a second half of 2025 layoff season. And then, of course, Donald Trump argues that because of tariffs, our economy is booming. But let's be real, our economy is booming in spite of tariffs. In fact, if it weren't for tariffs, we could probably confirm a soft landing today. In fact, we could have probably confirmed that months ago. However, because of tariffs, we might actually kill the very soft landing that we were in the process of achieving. What do we do about all of this? How do we put all of this together? Well, let's do exactly that and put the pieces of the puzzle together. Mind you, this is very similar to what we do in the course member live streams every day, where I give you my opinions as the market evolves every single morning when the market is open. Not only short-term trade suggestions, long-term suggestions, but also macro analysis, real estate analysis. And you could join that daily by going to meetkevin.com. Join and get your alpha report every day along with your course member live stream access. If you try it for 30 days and decide you don't like it, you can always cancel your renewal, but check out the options we have at meetkevin.com. So first, let's understand how to put all of this together. The first thing we need to know is that in the long term, it's extremely likely that rates are going to come down. It is highly unlikely we're going to see high levels of inflation that are anything more than one-time price increases from tariffs. And even then, it's unlikely given the lack of pricing power that companies have. This is, of course, my opinion. I could be wrong, but I believe over the long term, rates are going to go down. Donald Trump did delay these rate decreases thanks to tariffs. So we believe that rates are going to come down in the long term. we also believe that unemployment is going to go up in the long term. Both of these together are critical for you and your future, because one of the reasons, or the main reason, we're going to see unemployment structurally stay higher for longer is artificial intelligence. And it'll take decades for us to create all of the jobs that we've now lost and potentially even create more new jobs. That'll take decades. So what kind of jobs are really resilient today, and how could you position yourself in markets around this? Well, I believe the jobs that are most resilient today are anything that relates to physical or social. So think about nursing patients. Think about setting that IV line, giving that anesthetic, giving the shots, that epidural, the doctor who's actually performing the surgery. Yes, can we be augmented by robotics in the future? Yes. But the physical will always be augmented for a very long period of time. I would argue at least our lifetimes and beyond. Physical and also the social connection. Do we really need a lot of social connection? I hate to say it, but in bookkeeping, no. In the future, a lot of these aspects, even today, will be automated away. But the physical and social space, these will last for much longer. In fact, there's research that people on their deathbed today would much prefer human interaction over artificial intelligence. They've already done studies on this, which is remarkable because I feel like we've only used artificial intelligence for a couple of years. The fact that they already have studies on this, I don't know if some labor union put that together and they're like, please don't fire the nurses yet. Who knows? But some specific jobs outside of nursing or doctors or some of these healthcare industry topics, and of course we'll talk portfolio construction in just a moment. Some other ones that I actually think will be relatively resilient for a while, real estate agent. Now, a lot of people think, oh my gosh, what do you need an agent for? You know, computers can put the documents together. Computers can put evaluations together. True, and they've already been able to do that. The difference is, just like the nurse example, a real estate agent is more of a therapist than they are a transaction processor. Now, transaction coordinators working for real estate agents or lenders might be more at risk because those jobs are often less reliant on relationships and more reliant on numbers or rates or fees. Something else to consider, and I know a lot of people don't believe in this one, but I personally think being a pilot will be less likely to be replaced by artificial intelligence in the long term, because who's going to get on a plane knowing that if that computer shuts down, nobody's there to fly it? You still need that psychological backup. Now, you might go down from 2 pilots in cockpits down to 1 in the future. And of course, a lot more things are going to get safer and more automated. But I think for quite a while, until we're willing to put our lives in the stake, into a chip and batteries, you're going to want that backup pilot for quite a while. Other places, obviously, to consider are contracting and trades. It's why in 2021, when I ran for governor in California, I promoted trade school and how we should really be encouraging plumbing, electrical knowledge, framing knowledge in our schools, so that way when people graduate high school at 18, they could go right into a job site and do something functional. Whereas today, people graduate at 18 and they have almost no practical skills. They have the skill to maybe go to be an undergrad student at college, but that doesn't do you much practical for the economy right away. So these sort of skills will all matter and will be very resilient for a while to this artificial intelligence revolution. No doubt that artificial intelligence revolution, as part of this Trump economic reset, is going to lead to higher unemployment. And so the more you can arm yourself with skills that other people do not have, the better. In fact, it's one of the reasons we're so excited about what we're doing over at HouseHack, because to us at HouseHack, we are developers. We deal with construction. We deal with fixer-uppers. We deal with in-person analysis that's difficult to do over a computer. It can be augmented by, but not replaced by. Very important distinction. So real estate, a big deal. Now, obviously, you can invest in House Hack. We have a non-accredited round open. You get a 5% yield per year, paid to you monthly, and you get all the upside in the stock once we convert our bond offering to shares, assuming our valuation goes up. Otherwise, you get your money back over time. Read the paperwork over at househack.com. You could read all the disclosures or see my videos on it. But that said, to me, this is a very resilient to AI business. However, it's also a business that can crack the egg to future AI technology to make it easier for us to augment what we're doing. Auditing, billing, you name it, rent collection, rent screening. It's augmented by, not replaced by. Very big difference. Now, when it comes to a personal portfolio and what risks there are in the economy today, the greatest risk, and this is not to say you need to panic and sell out everything, but the greatest risk that I believe people have and could lead to true pain in the next down cycle, I don't believe people fully understand the pain of leveraged ETFs. I've seen complaints circulate on social media for this, but most people aren't taught in schools why leveraged ETFs are so dangerous. They're great trading tools for maybe a 2 or 3 month period. Sometimes they're used in tax loss harvesting, right? If let's say you have 10% or a 30% exposure in bonds, and then you tax loss harvest those bonds, you move to a triple leverage bond ETF with a 10% allocation, and then after 1 or 2 months, you move back into the non-triple leverage. That's a tax strategy, right? That said, a lot of people might not realize that if you have a stock that is $100 and it goes down 30%, well, then you would have a stock that's $90 in a non-leveraged ETF, a stock that's $70 in a non-leveraged ETF, and in the leveraged ETF, you'd lose 90%, so you'd be down at $10. Now, if the market then recovered by, let's say, doubling, okay, so the market doubles, well, if the market doubles, then what we have is a 100% gain here or a 300% gain over here. So a double would bring this to about, let's call it, double is 10, 30. We got about $60 over here. Whereas over here, you'd be about $140. So in other words, you kind of got left behind a little bit because you've got the triple double over here, which is a 6x. But you have the double over here, which brings you to 140, which shows you that the difference between 140 and 60 is really the punishment that you get for being in a leveraged ETF. So I think leveraged ETFs are quite dangerous in downturns. And if you have exposure to leveraged ETFs, they're great on the upside, but you should really consider setting stop limits that are good to cancel. So that way you could step out of these ETFs automatically before it's too late. Leveraged ETFs could really hurt. In addition to that, which is less popular today because of leveraged ETFs, margin and being margin called on the downside, very risky. Want to stay away from margin. One opportunity to use stop losses here as well is if you're in margin, set stop losses that automatically, if the market declines, pays off your margin. And that way you don't have to get forced to paper hand your favorite shares and that sort of core portfolio you have as the market is falling. Now, the most important thing, doesn't matter if you're buy the dipping in stocks or real estate or you're diversifying to venture capital or house hack or whatever. The most important thing for you is to think about what can you do in this new economy we're going into in this Trump reset. What can you do to increase your skill set? And in my opinion, grabbing as much of the items that you can from this list helps you. In fact, I put my money where my mouth is. I'm a jet pilot. I'm a real estate broker. I run a company that develops real estate, handles construction, coordinates construction, analyzes real estate in person. It's a very physical-based business augmented by artificial intelligence. And then, of course, social media. You don't have a robot talking to you or some AI-generated prompt giving you the same thing that you've heard in your own pocket before. You're getting a human analysis from me because none of what you saw in this presentation is artificial intelligence. Now, the future could be replaced by AI, sure, but it's going to start sounding like AI, commoditized. Everyone's opinions blend together. It's one of the reasons why I don't love using artificial intelligence for my social media, and I don't love watching other people on the internet because all the information starts blending together. It gets commoditized. Everything sounds the same. So if you like this sort of unique perspective, make sure to subscribe to the channel and check out our sponsors, link down below. So, big bottom line, your homework, build up that skill set, don't go bankrupt on leveraged ETFs or margin, and know that in time, rates will come down and longer term unemployment is going to go up. So be careful in that labor market.